Hi everyone. In this series of Chapter 16 study guide videos, we will work 3 different income tax problems. You can write your answers on a piece of scratch paper as you watch the videos, or you can download the Excel workbook embedded on the study guide page just above the videos and use Excel to work the problems. If you use the Excel workbook, please note that there are 3 worksheets included in the workbook, 1 problem per worksheet. Just click on the tabs at the bottom of the workbook to see each worksheet. As always, you will get the most benefit from these study guide exercises if you will please take the time to pause the video, do the necessary calculations, and write journal entries. Then start the video again to check your work. If you got it right, you will feel great. If you didn't get it right, that's okay. Now is the time to understand your mistakes so you don't make the same mistakes on the upcoming exam. There will be a detailed analysis of the correct answer that will help you identify and fix your errors. Let's start with the net operating loss problem. In 20X1, its first year of operations, Johnson Dynamics reported a net operating loss of $125,000 for both financial reporting and income tax purposes. The enacted tax rate is 25%. I will tell you that referring to illustrations 16-13A and 16-13B in your textbook for guidance will really help you with your calculations on these multiple parts of problem number 1. So pause the video long enough to turn your textbook to those pages. Then answer this question. Does this scenario create a deferred tax asset or a deferred tax liability, and why? A net operating loss, also known as an NOL, can be used to reduce taxable income in future years. So an NOL creates a future tax benefit and results in a current deferred tax asset. So the answer to number A is deferred tax asset. Number 1B, calculate the amount of the deferred tax asset at the end of 20X1. The net operating loss is $125,000 times the 25% enacted tax rate results in a $31,250 deferred tax asset. Number C, prepare the journal entry to recognize the income tax benefit of the net operating loss for 20X1. We need to debit the deferred tax asset for $31,250 to move its beginning zero balance to a $31,250 debit ending balance. As stated many times in my previous instructor video lectures for Chapter 16, and as stated in the textbook, income tax expense is a plug number. It's a combination of the amount necessary to move the deferred tax asset or the deferred tax liability from its beginning balance to its ending balance, and that could be either a debit or a credit, and the credit balance in income taxes payable. Because there are no income taxes payable in a year where taxable income is zero, then the income tax expense has to be a credit of $31,250. This is actually an income tax benefit of $31,250 credit. Number D. During 20X2, its second year of operations, Johnson Dynamics reported pre-tax accounting income of $140,000 for both financial reporting and income tax purposes. Calculate the amount of 1. Income taxes payable, 2. The ending balance in the deferred tax asset account, 3. The debit or credit necessary to move the beginning balance of the deferred tax asset account to its correct ending balance, and 4. Income tax expense at the end of 20X2, assuming the enacted tax rate is still 25%. I will again refer you to illustration 16-13B in your textbook. That illustration will really help you with these calculations. The current year is 20X2. Pre-tax accounting and taxable income is $140,000. The NOL carryforward is actually $125,000, but under current tax law, it's limited to 80% of taxable income. So $140,000 times 80% equals $112,000 of the NOL that we can use against taxable income in 20X2 on the tax return. That means taxable income after the application of the maximum NOL is $28,000 times the 25% enacted tax rate equals income taxes payable of $7,000. $28,000 times 25% equals $7,000. If the entire amount of the NOL carryforward is $125,000, and we used $112,000 of it in 20X2, then we still have $13,000 that we can deduct against taxable income from this NOL in the future. Times the 25% tax rate equals an ending balance in the deferred tax asset account of $3,250. That's $13,000 times 25% equals $3,250. We've done our calculations, and we've pulled up a couple of the numbers that we needed in these questions above. Number 1 says, how much is the income taxes payable? It's $7,000. Number 2 asks, what is the ending balance in the deferred tax asset account? That's $3,250. But number 3 asks, what is the amount of the debit or credit necessary to move the beginning balance of the deferred tax asset account to its correct ending balance? The best way to set that up is through a T account. I love T accounts. The textbook loves T accounts. You need to learn to love T accounts. Let me show you a T account. Here's a T account for the deferred tax asset. At the end of 20X1, we debited that account for $31,250. We know that the ending balance in the deferred tax asset at the end of 20X2 has to be $3,250. So what has to happen to the account to move the beginning $31,250 debit to an ending $3,250 debit? We have to credit the account by $28,000, because $31,250 minus $28,000 equals $3,250. So the answer to number 3 is $28,000 credit. Number 4 asks, how much then is income tax expense at the end of 20X2, assuming the tax rate is still 25%? As I said earlier in this problem, as it says in the textbook, as I stated many times in the instructor video lectures for Chapter 16, the income tax expense is a plugged number. It is the number that you need to make the journal entry balance if you are going to credit income taxes payable for $7,000 and credit deferred tax asset for $28,000, then you must debit income tax expense for $35,000. Now we have all the pieces necessary to write our journal entry to record the 20X2 tax provision. Income taxes payable are $7,000. We need to credit deferred tax asset $28,000 to get its balance stated correctly, and we need to debit income tax expense for $35,000. So go ahead and write the journal entry to book the 20X2 tax provision. Debit income tax expense, $35,000. Credit income taxes payable, $7,000. Credit deferred tax asset, $28,000. Well, that's all for this video. In the next video, we'll work another income tax problem involving an installment sale. See you next time.